Let's move on to China. Recovery continues to disappoint with another slew of overnight data adding to signs of a slowdown. Both industrial output and retail sales growth weakened in May from April and came in below analyst estimates. And now the Wall Street Journal is reporting Beijing is preparing for a, quote, new spending drive and other stimulus to revive China's flagging economy. So should you throw in the towel on investing in China or just get started? Joining me now, Stephanie Link is Hightower Chief Investment Strategist and a CNBC contributor, and Jason Su is Ralliant Global Advisors Chief Investment Officer. Welcome to both of you. Steph, we got to talk China because it's confusing and it's so important to kind of the overall macro. Where do you think people should be looking for opportunities?
I think there are a lot of opportunities out there, mainly on the services part of the economy and also just the consumer in general. So we know the recovery in China has been sluggish. We get that, right? But we have seen a lot of monetary policy inputs over the last couple of weeks, and I think you're going to see more. So they already cut the central bankers. They cut the 7-day reverse repo rate. They're injecting liquidity. The new bank lending program in May, it's up to 190 billion. And of course, they lowered the rate on 33 billion one-year medium-term lending facilities last night. So all of these things are small, Kelly, but I do think you're going to start to see even more of these because the economy is taking a long time to recover. But as I mentioned, I think services and consumers where you want to be. If you look at the PMI services numbers, the last reading we got, 53.8. We have gross gaming revenue in Macau up 173% year over year. The first five months of the year, the gross gaming revenues in Macau totaled $8 billion. That's versus $5 billion all of last year. And of course, retail sales, I know that they disappointed, but I would take a 12.7% retail sales growth number any day. It's way better than anybody else, right? So that's why I say focus more on the consumer, focus more on services, because I think that's where the opportunity is.
That said, Steph, real quickly, it looks like you're playing this through some of the U.S. Players with China exposure, Las Vegas Sands, Estee Lauder, which is a good contrarian pick, as opposed to the Chinese-listed companies themselves.
Yeah, I just find that the transparency for China pure plays is limiting. And you can wake up one day and all of a sudden the government will remove the CEO for no reason. So you can do all the fundamental analysis that you like, but it just doesn't pay off most of the time, at least in my experience. So that's why I think Las Vegas Sands has 40% of their 40% of their total exposure in China in their revenues, and Estee Lauder has 30% exposure in China. And Estee Lauder's been a dog. I think you can really buy this one at a good price if you have a long-term perspective.
Yeah, one of the most surprising quarters that recent one was with it, but telling about China. So, Jason, are you doing individual stock picking as well, or how would you describe your investment approach to China?
We're both looking at the macro and, of course, the micro. So we certainly study bottoms up, industry-wide trends, but also, obviously, as Stephanie mentioned, keenly interested in where the policy wind is going to lean.
So tell me what are you doing in terms of China? You bullish on China? You bearish? What's kind of your take on what's going on with the economy here?
Yeah, so we're a contrarian value investor, and so for us, China is a particularly interesting opportunity right now because it is disappointing expectation. There is sort of scary geopolitical optics risk, and what better time to buy than when there's a lot of risk and the risk premium is probably overcompensating for the optics risk versus the actual risk on the ground. We're not surprised by the fact that the numbers are softer than expectation, but as Stephanie mentioned, it's still a fairly good number versus what you can buy in terms of growth anywhere else. And right now, I think, all eyes on what Beijing is going to do. And in some ways, sort of soft numbers are good news, right? Because that forces Beijing's hand, right? It's got to roll out the much anticipated fiscal stimulus, the big package that are rolled out post the global financial crisis that really turned around China's economy. Now, right now, right, what you don't have is not the capacity issue, right? Everyone has the capacity to spend. There's been enormous savings rate, a lot of money trapped in the banking system looking to spend and to invest. But what's lacking is confidence. And confidence, I think that can get turned around with more fiscal stimulus, with a big announcement on the monetary side, suggesting that Beijing does care about GDP and GDP growth after all.
So would you have people invest this through, a China ETF, that kind of thing, or what would be your strategy?
Yeah, absolutely. I mean, I generally don't recommend investors to buy individual stocks just because especially in a marketplace like China, where, as Stephanie mentioned, the fundamental is a bit less transparent. So you actually need someone who's on the ground. The geopolitics, that can whipsaw, and so you really need someone who can sort of help you read the tea leaf in terms of what policy wind is leaning. So I would say, buy an active ETF where someone's managing the exposure for you and is much more broadly diversified versus you listening to a story and then buying a stock tip.
All right, we'll leave it there. Jason, Sue, Stephanie Link, thank you both.